U.S. GDP absolutely surging in the third quarter, so everything must be okay, and we're all going to get shiny presents as we get into the end of the year because the stock market is surging and everything's okay. Right? No, of course not. Welcome to Macro Money. This is Ilya Spivak, head of Global Macro here at tastylive. And we did get a scorchingly hot GDP number today, and that's not exactly how the markets read it. So what we're going to do here is we're going to have a look at what happened, why, and then see what happens next, because we have another piece of U.S. economic data just up ahead, a mere 24 or so hours, even less at this point, that portends more fireworks. As ever, if you're watching this on YouTube, jump into the comments, share your thoughts. Where do you think U.S. growth is going? What do you think that's going to mean for stocks going forward? And what you think the focus for these markets is going to be as we head into year end. We'll start here with a bit of stage setting. Here's that GDP outcome, 4.9% for the third quarter. Incidentally, that's the highest since that 7% peak that you see at the end of 2021. So if this surge of 34.8% is the kind of knee-jerk out of COVID, then settling, then the catch-up growth, where the economy finds its feet as the reopening begins, is peaking at 7%. Well, this 4.9% was the highest number since that, which obviously is very eye-catching. I should point out that from here, the forecasting, that's in the orange there in the dotted lines, is for growth to slow significantly. We're not expected to see numbers over 1% again until the second half of next year, and then not returning to 2% until March quarter of 2025. So that's from the survey of economists by Bloomberg here. But nevertheless, I mean, a huge number, huge jump in growth. So how do markets respond? Stocks are down. NASDAQ is, in fact, leading the way lower, down 1.5%. S&P down a little bit less. And the Dow, which is not here, is down even less. So there's a kind of safety to risk alignment in equities, where the riskier NASDAQ, the more growth sensitive, the more cyclically sensitive NASDAQ, that's lower. Of course, a lot of the winners this year are concentrated there. The tech sector has been very much the standout this year. In fact, taking the tech sector out of the S&P, for example, gives us a down outcome on the year, whereas leaving them in gives us a 10% or so gain still. So we're looking at a situation where clearly weakness is being applied greater to more cyclical names, which is a funny response after news showing us that the cycle is as robust as these third quarter numbers would suggest. Crude oil down a lot, and as if to make the point emphatic that this is not about some sort of a supply disruption around conflict in the Middle East, gold and the dollar are unchanged. Interest rates, in the meantime, down. The 10-year rate down, the 2-year rate down, bonds, of course, up inversely. And so the response very much risk-off classic. Numbers come out, they're gangbusters strong, 4.5% expected, 4.9% realized, and the market goes, right, that's it. That's the peak. It's all downhill from here, because the response across financial markets is of an economic weakening period going ahead. Bonds up, stocks down, crude oil down, and clearly for not a geopolitical consideration, looking at gold, and the dollar is idle, as if to say, We don't like the lower interest rates, but we like the risk aversion. The dollar is ever a beneficiary of widening yield differentials here since about the middle of 2021, as the Fed led other central banks to raise rates, but also, as usual, a beneficiary of risk aversion, because when markets go down, risky assets in particular, the cashing out typically favors dollars because it is the most liquid, most widely used currency. And so it is much easier for it to absorb large capital flows without too much volatility. And of course, if people are running from volatility, the most liquid currency that is the least volatile by extension is exactly the thing they want to cash out into. So US dollar seems to be stuck in between these competing forces. Gold seems to be stuck in between the same competing forces. The dollar here idle, but yields are down, which should be gold supportive. But because of the lingering risk-off situation, they actually hold up, anticipating what comes next. And so the response very much speaking to that was the best growth we're going to see for a while. And of course, the corollary idea to that is the Fed finally might be on track to start laying the foundation for rate cuts. And indeed, if we look at the policy curve as it presents itself currently, the current market rate, 5.38. Obviously, the Fed sets its rates in a range between 5.25 and 5.5 is the current setting. 5.38 is right in the middle. So that's the effective overnight rate, the effective Fed funds rate. And what we can see here is there is no change for the next 6 months. So essentially, going into the middle of next year, stasis. From there, we start to see cuts. And about a year from now, we see rates coming down to about 4.7%. In other words, we come down 50 basis points, erring toward something closer to 75. In fact, the likelihood that we get 3 rate cuts next year for 75 basis points in total, easing at this point calculates to about 97%. So the market is all but certain that we are going to get 3 cuts next year. And this is where things get interesting. The market has seemingly decided that whatever catch-up growth the U.S. was going to have has crested. It seems to have decided that things from here are going to be a lot more challenging, and the Fed is going to have to do more about it. Hence the response from bonds. But what if all of that economic weakness is coming and the Fed doesn't respond, or at least doesn't respond as quickly as the markets would like? Well, that would, of course, imply quite a bit more risk aversion, because the Fed will have delayed the medicine even as the patient seems to have become more sick. And so any news flow that might muddy for the markets their expectations that rate cuts are on the menu by mid next year is at this point an acute risk. With that, we get the Fed's favored inflation gauge, the PCE index, rounding out the week for us here. And at face value, not much to see here. The expectations call for an orderly disinflation at the core level. Expectation is we're going to come down from 3.9 to 3.7%, very much in line with the trend. Certainly no major changes expected in the makeup of goods and services. Services is still the place where the Fed is looking to have the most impact. And inside there, it's the labor markets that the Fed's focus remains. Because, of course, the housing component still remains the biggest contributor to service sector inflation, but there's not a whole lot the Fed can do there. Much of that increase in housing services prices is the Fed's own doing. in raising interest rates as high as the Fed has done. It has pushed mortgage rates available in the market to well north of 7, approaching 8%. Meanwhile, the outstanding rate on mortgage debt already taken out by home buyers is 3.6%. So anybody wanting to sell a home here would have to sign up for the proposition that they're going to be paying 4% more for whatever mortgage they get now versus whichever one they had locked in. Not surprisingly, nobody is really very enthusiastic about selling homes. Hence, the prices remain high, and the cost of housing-related services for upkeep and construction and whatever else needs to happen to allow one to stay in one's home rather than selling it, that's exactly what seems to be going on. Not surprisingly, then, the focus in bringing that service sector inflation down is on unsticking wages, which have been, in many instances, locked in at higher levels during that labor shortage on the way out of COVID. A labor shortage that incidentally still persists, albeit to a narrower extent. And so all of this remains the same. And yet, what we saw just 2 weeks ago with US CPI data gives us at least one reason to worry. Here is the outcome of that CPI report. Nothing to see here, and very similar, one would think, to what is going on in the PCE. The focus is services, goods inflation is all but squeezed to nothing. Energy is less of a negative contributor, but of course, there's not much the Fed can do about energy prices either. It's not as if Jay Powell can call Saudi Arabia and tell them not to try to tell markets that they're going to cut output, as futile of an effort as that likely is. Looking at how successful OPEC and their allies have been over the past, let's call it, 4 to 8 years at actually managing quotas. We then have the Fed focused on the labor market because that's what it can focus on. Looking at the core here, looking at the core here, very similar story. One would think all of this is not especially relevant for markets. And yet, we get a slight pop at the headline number, very modestly, 3.7% versus 3.6%. What's more, if we look at where that pop came from, it came entirely from energy becoming less of a negative influence on prices. All of the things that the Fed ought to care about, all of them went in the correct direction. Core went down. Services, excluding food and energy, went down. Even food went down. But holding energy and food aside, all of the Fed-relevant components of inflation moved in a direction consistent with the Fed getting closer to being able to cut. Markets did not care. Let's have a look at what has been the driving narrative, really, since the middle of the year. We get out of the banking crisis. We get out of the first episode of the debt ceiling tragedy, drama, however you'd like to call it. And the market begins to shave rate cuts out of the forecast because they judge, okay, the banking crisis appears to be somewhat contained. The situation with the debt ceiling appears to be somewhat contained. The amount of easing that the Fed would have needed to do to offset those negative catalysts, that's probably overdone. And so you see the outlook as implied in Fed funds futures for the last two remaining meetings of this year that still stand, November and December, and through the end of next year, through the end of December 2024, goes from a net closer to 175 basis points in cuts over the course of the subsequent several months, from about July onward to now about 75 basis points, give or take. The response in markets is unmistakable and really begins to have very clear impact when the Fed has its September 20th meeting and delivers its higher for longer confirmation. Markets, of course, were already angling in that direction, hence the rate cut spread starting to come in and stocks starting to decline before that meeting. So you can see right about here is, give or take, the floor. And this is where rate cuts start to get more modest. It's also where you get the top in the S&P and it starts to edge down. But the real meat of the weakness is right here. And this is where the Fed has its telltale September FOMC announcement, where it comes out and says, actually, we think rates need to be 50 basis points higher next year than we thought back in June because growth is going to be stronger and inflation is going to be stickier. And the market, of course, does not like that one bit because it is ostensibly anticipating that we are going to have the meat of these rate hike squeezes hit and growth start to peak, just as we have apparently seen it today in these third quarter GDP numbers. And so what we see here then is from that September 20th meeting where the Fed says, look, we are going to probably be okay with stopping the hikes, but we're not cutting anytime soon. There is risk aversion and the market starts to price in 50 basis points less of a cutting scope and adjusting risky assets for higher borrowing costs to that extent. Notice what occurs here. Stocks come down. Then you get an NFP number that's relatively rosy, and the market considers, well, it's a rosy jobs number, but surely we've already done most of the pricing in, and so now things can recover. And then the October CPI number. As you'll notice, that marks the top in stocks. And again, this was a CPI number that should not have materially altered the Fed's calculus. One might argue it didn't. But the very appearance of that number seems to have cemented higher for longer in the minds of investors, and stocks subsequently fell. You can see that the reprieve did not even have any time to build when Powell came out, Fed Chair Jerome Powell, last week, in fact, exactly a week ago, and said that maybe the upshift in yields that precipitated this decline in stocks as the higher for longer move was baked in. You can see that in spades right here. Here's that same FOMC announcement. And you can see in its aftermath, long-term yields go up even as higher for longer, but no more rate hikes rather, shows up as standstill at the 2-year rate, the more policy sensitive rate. Powell says that's already done the heavy lifting for them, or at least hints as much, and suggests that the problem here, or at least the reason rates are going up, is increasing term premium, which is another way of saying people just see borrowing over a longer period of time as more risky and want extra compensation to lend for longer periods of time, say 10 years, than shorter periods of time, say 2 years. And that very time elapsing component merits additional compensation because there's more uncertainty, because growth is peaking. And the Fed is not being forthcoming with the medicine in saying that they're going to hold rates higher for longer. So Powell comes out and says this as if to hint maybe we don't have to hike rates literally by 50 more basis points, and nevertheless, the markets keep falling. We can see that with that September 20th announcement, financial stress picks up. This is the measure of financial stress from the Office of Financial Research, an arm of the U.S. Treasury Department. We can see when the Fed makes that announcement, it turns. Stocks turn. At the same time that it turns, we notice that looking at the Fed funds outlook 12 months forward, not any particular meeting, but just 1 year forward from any given point here as a running number, that doesn't even have to go up. Just the uncertainty of what longer in higher for longer means is enough to create consternation in this market. And we get to a situation where just that increase in uncertainty, as displayed by what's going on with the widening of the spread and the term premium powering of that widening, that's enough to be a negative catalyst for stocks here, and then naturally raises the question, well, what happens if we get something on this PCE number that is in any way akin to what we saw here? And though the response may be as inconsequential for Fed policy as this was, maybe the response is this anyway. And so with that in mind, we prepare here for a release that may give us just enough headline to have a bit of a surprise and a burst of volatility. And if that's the case, if we're going to see that carry through here, well, then we might very well end up with an amplified version of this exact response, which is to say lower risk, lower cyclical assets like crude oil, more of a painful experience at the more cyclically sensitive parts of the stock market. So a worse time for the NASDAQ than the S&P or the Dow. And of course, very tellingly, that the dollar isn't rallying against this backdrop suggests all of this starts to bode ill for the greenback. Because whereas overnight the ECB signaled it is done with rate hikes and it is looking out to potentially easing by mid-year next year, the euro didn't fall, as if to say we are so worried that growth has peaked that we now want to send capital to that part of the market where the relief will come soonest. And that seems to be Europe rather than the US, where this higher for longer uncertainty persists. And so if in fact there is something spooky in these PCE numbers, even superficially so, the results may well be negative for shares, they may well be negative for other cyclical assets, but they might also be negative for the dollar, especially against the euro, where perhaps a bit of a lifeline is closer at hand. And so capital wants to move out of USD denominated assets, however tactically and however temporarily, into those denominated in euro terms. And that is macro money for today. It's also the last macro money for this week. We are here Monday through Thursday every week right after overtime, a show I co-host with Chris Vecchio and Dylan Radigan. I'm on with Chris again for Futures Power Hour tomorrow, on with Tom and Tony for First Call on Sunday, writing for the News and Insights portion of tastylive.com. As a matter of fact, a summary of this very analysis is there at the moment. And also opining sporadically on the platform formerly known as Twitter at Ilya Spivak. Thanks very much for joining. Macro Money will be back next week. I'll see you for Futures Power Hour tomorrow. Good luck out there in the meantime. Take care.